Welcome, guys. It's good
Thank
to
you.
see you. And John, first time on center stage.
Yeah.
Welcome.
My 14th year at Phocuswright, I think, but first time I made it up here, so.
You made it. You need a pin, I think. We're going to have to get you a pin. Okay, so Christoph, you guys are in really good company. Serena Williams, Jay-Z, Paul Ryan, Peyton Manning. I could go on. Richard Branson, too. Seems like everybody's creating a SPAC these days. So first of all, what is a SPAC? And why are they suddenly so popular?
Oh, my God. That's the million-dollar question. And I frankly think whenever you see Shaquille O'Neal announce his participation in a category, it's usually a very bad sign. No offense to Shaquille O'Neal, but... So, a SPAC, essentially a SPAC is an alternative way to get public as a private company. And it's a little bit of a funky vehicle. I'll try to take a couple of seconds and just explain it. So, what we do as SPAC sponsors is we form an entity and we make the decision that we're going to raise money on the public market. So in our case, we raised $150 million SPAC in the public markets. We went out to the markets and basically said, we're going to find a target company to merge with, and as a part of that process, they're going to become public. So we have our own little roadshow, we pitch to investors. If it wasn't COVID, we literally would go to the NASDAQ and ring the bell, and the company goes public, and it's funded. Now, the company is, in essence, this $150 million sitting in a trust account that we can't touch. We can't spend it on anything. We have to put our own risk capital to work, and over the next year and a half, sometimes in the old days, the luxurious old days, 2 years, we would run around and meet with private companies and encourage them to consider merging with us. So at the end of the day, when they merge with us, because we're public, we're buying them, and they become, as part of that process, a public company. And the pitch to the private companies essentially was, this is a faster way to get public than the traditional IPO. This is a better channel through which you can talk about your future plans, which is something that you can't do under traditional IPOs. And it's a path where you can have more control over valuation. You can discuss that and negotiate it in advance. And so it all painted this really pretty picture for a world where product in the public markets has been going down for decades through consolidation, but also when compared to the amount of capital that's actually in the public markets, there's been a disconnect in product for some time. You have a broken traditional IPO process that's just a pain in the butt, right? It's only for real big monster brands, and the banks are saying, nah, you're not ready to everybody else. So you have that disconnect. And then you have a world where companies have been staying private longer. There's a very efficient growth equity marketplace out there, and companies have been staying longer. That's why we see so many unicorns, and we continue to see them. So the SPAC, sort of the maturation of SPAC over the last couple years was to sort of fill that void or take advantage of that conflict and get companies public faster and more efficiently.
But they're not a new thing, right? SPACs have existed for a while. So what's behind the sudden surge in companies going public via a SPAC merger?
Well, I think it's been a few things. I think it's been this interesting dynamic of an insatiable appetite for new product at the public level, a sort of clogged up and broken IPO process, and an environment just flush with billion-dollar-plus private companies that created, the material for more professional managers, sponsors to come to the table and start participating in the vehicle. In the old days, sort of before this new renaissance of SPACs, they've been around for a long time, as you say, but it was sort of that, the SPAC was a dirty word. It was the little vehicle that found a beat-up, crappy company and just tried to drag it to the public markets and, get away with a few, tricks along the way. But it's changed dramatically, and unfortunately, I think it's going through the kind of growing pains that you see in any market that suddenly just explodes. It loses balance. I think that's coming back, but it's going to take some time.
And that's true in Europe too?
I think I would describe it a bit different. I think from a founder perspective, so what a founder as products really has is the early venture capital funds. So we are a venture capital fund, for example. We are investing into travel companies like Get Your Guide, or Omeo, Home2Go, and others. So we have an early fund, we have a growth fund. And let's say the idea of why we did it was we want to follow the journey of a founder from seed up to IPO. And then you have two products, early and growth fund, which is nice. But then there's a missing piece between a growth stage company, which is maybe Series B, C, or D, and the classical IPO. And then I think what Chris and we are doing in the same way is saying, we have a dedicated product to, let's say, help founders to get access to public markets earlier than a classical IPO. And I can explain it in the example Home2Go, which we de-SPAC'd just a few months ago as the first European SPAC. So we know the founders, we know the quality of the product market fit, the traction, but it was obvious that for the NASDAQ or for the Frankfurt Stock Exchange market, it was too early, but the idea of a vacation rental platform, aggregation platform, was really good, and we thought about how to, let's say, get the money of 250 million euros, which was the idea, and then the SPAC is a perfect product because you help the guys to, let's say, go public a year earlier. These guys can do acquisitions, they can spend money on the marketing side, and that's why we as Lakestar, we thought about having this product in, let's say, in between the IPO and early and growth fund. And founders like it because then they have, let's say, different products alongside their journey.
And John, you're actually using that route to market.
Right.
So why? And is it like Christoph said, you know, it's kind of that bridging stage?
Yeah, I think in the past, at our size, we might have looked at a late stage VC, but now this opportunity gives us a broader, base of investors. What Chris said was correct. We were pitched that we could get to market quicker, and so that's important when you're trying to time a market. Let's say you want to take advantage of the travel tailwinds next year. You want to be able to get out in time to take advantage of that. And I think that's the reason you're seeing so many travel SPACs right now is they're trying to take advantage of the tailwinds they're going to see next year. But for us, we also, we're a bootstrap company. So we took a different path. We never took outside funding. So this was an opportunity to inject cash, take advantage of the growth we're seeing and make it grow even faster. And without some of the strings of a typical late-stage PE deal. We have a lot of partners and friends and family that can now partake who have been asking us how they get involved, and now they can. And then the last thing I would say is the SPAC we chose is has a lot of great experience. They took BurgerFi public last year. So they're a very experienced team. They're making a lot of connections for us. So now we're getting plugged into the Silicon Valley scene, which wasn't available to us before. So for all those reasons, it seemed like perfect timing.
Okay. And, Chris, you alluded to this, that SPACs are having a bit of a rough time. I was looking at some numbers. 97%, this is going back to September, but still 97% of pre-merger SPACs were trading below their $10 offer price. Nearly 60% of post-merger companies were below that level. Is this really like a viable alternative for companies to go public? And to John's point, friends and family kind of participating. Are investors really going to make money, or is this, the sponsors that are going to make some money out of this?
Yeah, I mean, I think it's. First of all, I don't think you can look at the entire universe of SPACs as one thing and then draw conclusions from its efficacy by looking at the averages, right? I do think that when you have a quirky capital markets product like SPACs, because they're a very clear subset of investors who participate in SPAC IPOs, There are very clear subset of investors that participate in SPACs for IPOs, and then it takes time to percolate after going through a de-SPAC and being a public company to grow value, and there are many examples of companies that have thrived in the public markets after getting there through SPACs. But I think what happened was, especially in the first quarter of this year, there was such an incredible increase in the number of SPACs and the amount of money raised. And then there was a sort of quickly following that, there was this sort of euphoria in the pipe market, and a lot of it was just sort of playing the pop on announcements, because the old Reddit retail market had come over and was playing in SPACs, and so it just created this frenzy, and that's just never healthy, right? There are a lot of very transaction-oriented SPACs. It didn't take a lot to get a SPAC public in the first quarter of this year. And that, all of that created a real drag on the marketplace. And so now, we live in a world where redemptions are very high. This is an important feature of the SPAC market that's different than others. That 150 million I talked about that we took public and is sitting in our bank account, still is. When we have our shareholder vote at the very end, after the SEC has approved our documents and everybody's, we're going to go through the final de-SPAC and our target is going to become a public company, we have a shareholder vote. And at that moment, two things happen. People, first of all, approve the merger, which they almost always do. But then every investor at that point has a choice. They can redeem their stock for the money that's in trust. They can get their money back at that point. Or they can stay in, and that money goes onto the balance sheet, or it really stays on the balance sheet of the new company. That redemption has become a big problem because arbitrage players, hedge funds, specialize in making investments in SPACs after announcement before they de-SPAC, and they play that gap between where the stock is trading and the cash that's in trust. So if there's $10 in trust and the stock is trading at $9.60, hedge funds are buying it at $9.60 with absolutely no intention to stay in the deal. They're going to redeem. And so we've now seen redemptions climb to close to 60%. So what used to be sort of a reliable infusion of capital onto the balance sheet of the company as it gets to the public markets is now unreliable. A lot of those features have come out of this sort of this overheated growth. What I think, though, the wheat is beginning to separate here from the chaff, and part of it is that I think there's a difference in sponsor types. There are very transactional sponsors, and you can tell by who the sponsors are. The people behind it, they're looking to get a deal done. They frankly they don't care anything about what the company does. They just want to get a good deal done because they can make a lot of money. And then there are more operational, sort of operator-oriented SPACs that have built sector-focused teams, that have a legitimate board of directors that are in it for the long haul, that join the boards of the companies that they merge with and take public, and bring value to the table, not just through the transactions close, but well into the future, help the companies perform as public companies, guide them strategically, work with them when they want to do secondaries and raise more money in the public markets. And that process, I think, is very healthy and is going to continue, because the traditional IPO path is unreliable. And it's not for everybody.
I'm going to come to that in a moment, just talking about the long term. But Christoph, you guys, when you took Home2Go public, you have a very interesting structure to that. You have some skin in the game. So can you talk about that a little bit?
Maybe I talk about the process and then the skin in the game. I think what was interesting in March this year, so the team got some term sheets from sponsors, and then they decided to set up a proper process. So they contracted an investment bank, and this investment bank then compared the different offers and did the negotiation, and finally the team decided which term sheet to take. And there were different term sheets, so let's say European SPAC term sheets and US SPAC term sheets, and for a founder in Europe, so maybe it's also important whether the IPO happens in Europe or in the US, so that was something. But there was another element you are mentioning, that the alignment of the sponsor and the other investors I think we did a nice thing because the conversion of the sponsor shares are dependent on the share price. So there's not like some, let's say, the first SPAC generation, and Chris and I discussed about it, was just about, let's say, when the IPO is done, the sponsor job is done. And we thought about, we want to follow the journey, and we want to align on getting the share price up over time. And that's why we define different steps of share price and different levels of conversion of sponsor shares. And I have to say, this is a fair way of, let's say, keeping the sponsor interested in the journey, and also for the dilution of the founders, it's fair that they don't dilute if the share price over time is not developing. So I think that is something which, so when we talk about the future of SPACs, I think this kind of alignment is one thing. And the second thing, Chris, you also mentioned, is that the warrants you get when you invest into, you don't lose them if you redeem. So there's an incentive to, let's say, invest and then redeem because you keep the warrants. And I think that is something in the model which is not properly thought through. That is something we have to change in future. Because if you redeem, I don't know why you should keep the warrants in that case. So, but these are all, let's say, 2.0 sponsor thoughts which everyone is having who is involved in that.
And John, sitting on the other side of this, was that part of the consideration when you were kind of, looking at SPACs, talking to
yeah, picking the right SPAC is very critical. We picked a SPAC that had prior experience, so they knew how to get the deal done, and there's a lot of pieces involved in the whole process, so everything has to go perfectly, and they knew how to do that. But also you want to look at their investor base. Some SPACs will have high concentrations of one investor who may pull out and redeem at the end, and then you're stuck. So we picked a SPAC that had a very diverse investor base with smaller investments, so that if some people pull out, there's no big guy in there that can crush the deal, essentially. And then, celebrity SPACs, you got to be a little leery because, what are they really bringing to the table? Yeah. In our case, we had a guy who was a former executive at Cisco, so he's bringing a lot of advice to the table. He's going to sit on our board. So there's a lot of intangible values along the way that they provide. We're sitting in meetings with them every day, and so they're really a part of the team now. So I don't want to badmouth how much they earn at all, because they're putting a lot of work in, and they took the risk at the beginning to file the IPO, which costs money, right? And gather up those funds. So but there is some adjustments there, I think, to be made, but it's close. It's getting close.
And turning that around a little bit, but when you decided that you were going to take Inspirato public, for example, or when you decided Home to Go, what is it that you're looking for? Is there something specific? How did you kind of hone in on a target?
Yeah. I mean, for us, it was very much a sort of a long-term analysis. We're long-term investors. It's in our DNA. We're travel and transportation tech investors. That's in our DNA. We knew that coming out of COVID, there'd be certain companies that had shown great resilience that wanted to get on the offense coming out of COVID, and they saw the tailwinds in the travel markets as being an opportunity to do that quickly. And so we were looking for a company with those attributes, but a company that had the potential to be, a long-term winner in a very big market. And in Inspirato, we have a company that's focused on a very attractive market, the luxury travel TAM. It's big, it's growing faster than other cohorts, it's incredibly resilient. The dynamics of it have changed as younger travelers enter that luxury cohort. Very interesting. It's a real estate story. I mean, Inspirato truly is a supply-driven story. And the way that they have put in place an engine for luxury supply acquisition, I think, is super compelling. And frankly, the way they're working with luxury hotels and taking advantage of the systemic problem in luxury hotels of no opaque channels for distribution has created supply, which has been interesting. And then overlapping that, of course, is the subscription model, which is a really interesting, that combination of a consumer subscription business with a pay-to-stay, travel business, all living behind a velvet rope. We liked it, and we thought we saw, we think we see the dynamics of, a winner-take-most type of a marketplace. Because it's hard to imagine what luxury traveler would want to join the number 2 luxury travel club that has inferior supply, right? So we saw those attributes, and we saw real revenue and a team that was public ready, and we just felt comfortable that it was the right transaction for us. But again, we're in it for the long haul. We're going to be working right through the transactions close. I'll be on the board of the company working closely with them for years to come. And I think that's the dynamic that this marketplace of SPACs needs to turn into, is truly a guided transaction, value-added conversation, as opposed to just some sort of a hypey capital markets product that gets a few people rich quickly, which it really isn't, because a lot of people are going to lose, I don't know if I can say this publicly, they're going to lose their ass pretty soon in the SPAC market.
You can say it.
So the other dynamic we didn't talk about, this is an important, SPACs have an expiry date.
Yeah.
So the sponsors put up all of this capital to get in the game, but if they don't close a target within now 18 months, we're seeing deals go public with a 15-month trigger. And let me tell you, that's hard to do, right? If they don't get a deal closed at that time, the SPAC expires, all of that cash and trust goes back to the investors, and all of that risk capital that was put up is gone. They just disappear. It's a 100% wipeout. So, there's something like 480 SPACs out there looking for targets. Many of them will have an expiry date of, Q3, Q4 of next year, rolling into Q1 of 2023. There's going to be a lot of little poofs in the capital markets around that time.
And Christoph?
Yeah, I think what we liked about Home2Go is that we know the team now for 5 years. We have invested 4 years ago, so we were on the board. So we have the journey, we have done the journey together. We exactly know that these are decent founders, serial entrepreneurs. They in the travel space, so these are no newcomers. So team was the first thing. Second, trust between us as investor and the founders, because the relationship is really close. And the third one is, let's say, the business model and the traction. And Home2Go is the biggest marketplace for vacation rentals. So they have 15 million properties on the platform. And we saw when pandemic happened that this model was really resilient. So and that we see a long-term trend towards vacation rental and workation and all this kind of thing. So team, traction, trust. So this all came together. But at the end, it's still a pitch. So you have to convince the team. And so I think that's, but if you are close with the team, so it's easier than if you're just jumping in.
Who has to do the convincing? Do you have to go and convince them to go public? Or, do you kind of say, hey, we think we're ready, let's kind of go and find someone that fits where we want to be in the next stage?
I mean, I think there's probably both, but in our case, we felt ready. We had a specific vision in mind, and then we talked to lots of different SPACs, and in some ways they were pitching us and we were pitching them, but eventually, you find the right fit. So.
And so ultimately, who wins? Is it the sponsors, the employees, friends and family, like you said, ordinary investors?
I mean, I think everybody wins, right? I mean, if it's a good transaction, everybody wins. If it's a bad transaction, the company still lives to fight another day. If it's a good company, it'll do well, and its stock price will rise over time, and employees will enjoy the fruits of their labor, and the SPAC sponsor will get wiped out. So the SPAC sponsor takes some risk. They have to do a good job of identifying a strong company and pricing it correctly. But I think in the end of the day, it's a very efficient financing vehicle, and it's here to stay, and it's good for the right combinations. It works for everyone.
And if I may add speed, the speed is impressive. So in our case, it took us 6 months from, let's say, contacting the team with the idea up to IPO. And I think if it comes to with the selection process, so selection was done after 3 months, and then 3 months after the selection, 3 months later IPO, I think that is something which you couldn't do as a classical IPO. So this kind of speed in it, if you like it and if you want to invest fast into organic and inorganic growth, I think that's interesting. But I think, Chris, you're totally right. If, let's say, the balance between dilution and the capital you have as cash then to invest, if that balance is wrong, so then I think it's not the right instrument. So the dilution is an important piece of it, and that's why the capital increase should be decent in that.
Okay.
You know, and a quick shout out to the advisory community, because this is complicated, and you know, whether, you know, in our case, Stifel, excellent bank, Evercore, excellent bank, Oppenheimer, excellent bank, UBS, they were all around the hoop. And it's really important because there's a lot of capital markets work that happens after a merger is announced, before the company de-SPAC. So anybody who's considering a SPAC, it's probably a good idea to find an advisor that understands the marketplace and learn about the pros and cons. I think that's very important.
Yeah.
One last question. John, if you had to do it again, SPAC, IPO, direct listing, putting you on the spot. I know there's only one correct answer,
Absolutely.
right?
So many great things have come from it. We're, you know, hopefully going to get a lot of cash to inject into our growth and grow even faster. We're making lots of great new contacts, meeting new investors. We're getting more publicity, deal exposure on the commercial side. So it's just been overall very positive.
And it's a good time, right? Travel's coming back very strong. Chris and Christoph, for you, another SPAC in the offing for either of you?
I have to say, in our team, so the SPAC team is a dedicated team, so I'm part of the venture capital team and the SPAC team is separate. But I think it all depends on the market. So we were the first in Europe who did that SPAC, and we want to see how the market evolves. So I think the team is carefully looking into it and deciding, but depending on the next few months, how it goes.
Okay.
Yeah, and we think it's a long-term part of our story. So we'll be in this for a long haul.
Well, we have some great companies out here who are probably looking.
Yes, we do.
But thank you so much. Great perspective, great advice. Our panel, Christoph, Chris, John, thank you.